I think we can start. We're not gonna wait for long.
All right, that is okay. Was planning to start in a couple of seconds, as we normally do. We normally start at 12:35.
No problem. We wait for 12:35 and then we start at 12:35.
Great. Thank you. Great. The time is now 12:35. Welcome, gentlemen. Those two gentlemen who just joined us, you are most welcome. Please remember that we need to all be muted to allow for the person who is speaking at that time to be audible without any interruptions. We believe that other people will be joining us, and I know that we are also having an audience there on Facebook. Welcome there to you on Facebook Live. Welcome to you on our Instagram Live. You are more than welcome today. So how we usually start this is that I break down what YDT Group does and the amalgamation of all the companies that are under it. So I wanted to just throw there a question for you. If you're there on our Facebook, please comment and let me know. And if you're here on our Zoom, please go to the comment section and let me know about the following. Someone said to us that they wish that we had broken down the terms that we use when we are doing these webinars and some of the terms that we use when we are talking all things property. So someone said to me, can we break down things like credit record rehabilitation? What does that mean? Someone also said to me that, can we break down what do you mean when we say bond originators? Someone also said to them, when we say property developers and talk about renovation, it sounds the same. So how do we mean when we say that? So I wanted to ask you, do you also agree that we need to just break down these terms further? Perhaps we can make a post about it and break them down, or perhaps we can just discuss them sometime during our webinars. As you know, Mr. Yabela is always asking for feedback, and he's always willing to make the appropriate webinar according to the questions that you put out there. So please communicate with us and let us know. So without wasting any time, I'm just going to talk about YDT Group. So YDT Group is an amalgamation of companies, and these companies are called YDT Financial Advisors. There's also YDT Property Developers, there's YDT Home Loans, there's YDT Real Estate Agents, and we have our in-house attorneys that deals with our conveyancing services, and those are Nozipotlali attorneys. Remember, we say that we are a one-stop property shop. That means that we are the only shop in the world, or the only company in the world where you go, you come to us, inquire about buying property or anything else related to property, and we offer all these services for you in-house. You won't have to go to the bank to get a loan. You won't have to go anywhere else for any other services, such as rehabilitating your credit record. Usually you go elsewhere for that. So we do all of these things in-house, and all these services are what makes us the best one-stop property shop in the world. So welcome everyone. Without wasting any more time, I'm going to give over to Mr. Yabela Tlali. Please remember, as you come in, please mute your mics, and remember that we have the questionnaire section. You can raise your hand at any time. I'll be engaging with you throughout the webinar. Thank you so much. Welcome once again.
All right, thank you, Tsiamo. Good afternoon, everyone. I'm seeing close friends. Today, the message went out a bit late. It was my fault. I was working for the first time in about 8 weeks before the webinar. I decided to go to work so that afterwards there's other contents that I'm going to upload here for everybody. So now, as we are getting started for today's topic, if you would allow me to share the screen with everybody so that everyone can see what we are. Aha, there you are. Hallelujah. Okay. I'm just gonna make it bigger. Yeah. I'm getting better at this. Soon I'll be getting a good qualification in computer, guys. So I'm getting there.
I'm very impressed, Mr. Lali.
I'm telling you, I'm getting there now. Today's topic, ladies and gentlemen, it is about today's market. The market is changing a lot, and I did say last week, and I didn't know that we were going to do it again already, because I had said at the latest every second week we are going to look at the market, at the current market, and we did look at it last week, and today we had no choice but to look at it again because of great changes that most of you have seen. What are the changes that, just take a wild guess. I'm allowing now, you can unmute your mic and just take a wild guess. What changes did you see, or what do you think are the changes I'm referring to based on what happened in the last 2 days, or even yesterday for that matter? Anybody? Not you, Tiamo. Anybody else?
Yes, not me.
All right. Did anybody else see any changes in the market yesterday? Something that can affect the property market? Unmute your mic and hoy.
Something very exciting happened recently.
What about the repo rate?
Aha, there
Yes. Well done, Gerrit. Well done.
Yeah, it's mostly it's basically about the repo rate. Okay. Now, what we have been focusing on almost every week from the last 4 or 5 weeks was teaching people to be able to interpret the market on their own, so that we can continue to interpret the market even when the webinars have stopped, even later on, even now already, because I will explain now again later why. And I'm sure we'll remember this slide. I'm sure it's the 6th time now this slide is coming up, because it is very important, and it will keep coming up until everybody really understands this in full. All right. Now, these are the factors influencing the market. These are the 4 main factors influencing the market, which is the interest rate and the repo rate. At the time I left that slide exactly the same because I wanted everybody to see the changes from the time we did it about 5 weeks ago. The interest rate then was at 7.25 from 9.75 on the 17th of January this year. And then the repo rate at the time of the slide was 3.75%. And it was 6.5% at the time we were at the beginning of the year, rather. I will explain again, because just like we had said at the beginning, we need to demystify the bomb words and the big words, because the whole point of these webinars is for anybody and everybody to understand exactly what we are talking about. Now, a interest rate, I believe we at least understand it is the rate. It is the prime rate that the banks or financial institutions are allowed to charge us from. So that is the base rate, meaning you can say it's a foundation, meaning it's the rate that they can work on as a guideline for them to charge us. Now, they then would say in your home loan approval or in any credit agreement, whether it's for a clothing account, any credit agreement that you have, they will then say prime plus. When they say prime, they are referring to the current national interest rate that they are all have been guided to use as the base rate. Of course, this is to make sure everybody starts on the fair base for all the credit providers. And then the bank will then, if, for example, with the interest rate, you are charged 10% for your home loan. That means then it is prime, which is the base rate, which is the 7.25 we're talking about. We'll look at the current rate now later on. plus the difference, which is 2.75%. The repo rate though, repo rate, because this one I always explain it because it took me a long time to even get it properly, the real difference with it up until I had to study finance. The repo rate is the rate at which the South African Reserve Bank charges the banks. Now, let me explain it further. When the banks give us money, a loan, home loan, personal loan, any loan, they have taken your savings that you've put into the bank. They go to the Reserve Bank and they say, I have got 1 million rand in my account as the bank that was deposited by client X, Y, and Z. 3 clients put this money. In total, I have 1 million rand. Can you borrow me money so that I can give loans to other people that might need them? And then the South African Reserve Bank then says, against the 1 million rand you have, the last time I checked was 1:8 ratio. So then the Reserve Bank say, against the 1 million rand that you have, we can borrow you 8 million rands so that you can lend the money to whoever comes to your doorsteps asking for financial assistance. Then the South African Reserve Bank gives the 8 million to the bank as a loan with interest, meaning the bank must pay back with interest. And that interest that the South African Reserve Bank charges the other banks is called the repo rate. So at the time of this, it was 3.75% that the South African Reserve Bank was charging all the banks, or any financial institution for that matter that borrows money from the South African Reserve Bank. Now, we go to the next one, because we had said we don't want to stay long, but I needed to explain this to demystify, but we've got more slides and we had said the webinars are going to be shorter. The second point that influences the market is the trade or the lockdown, meaning there's no trade normally during the lockdown. And then third point is the economy. At the time of the slide, it was expected to contract with 7%, meaning to shrink, to reduce. Remember, every year the economy has to grow, just like salaries grow and every other thing must grow. So the economy was expected, when we did the slide, to decrease by 7% and 5% globally. And the other factor influencing the market is the estate agents, because they are the people who are basically controlling the market. They're advising the seller, because most of the time the estate agent is representing the seller, because when you see on Property 24, the property that is being sold, that agent was given a mandate or the authority by the seller to be able to sell that property. So, and then another agent brings the buyer. So it's the agents that are basically controlling the actual sales within the market. Now, the market currently, which is what was and what is seriously exciting, and it changes so fast. It has not changed in this fast in at least 47 years. Now, first point, the economy has already contracted by 7.3%, meaning the economy has already shrunk, has become less by 7.3% already, meaning it has already exceeded the 7% that was predicted about 2 months ago. Now, it is now currently expected to decrease by 10%. That is a serious big blow. So that everybody can understand why is it a blow. Just to put it into perspective, the economy normally grows, for an economy to be said that it is growing good and well, it must be growing every year with 6%. That is a good rate for an economy to grow. That is one of the rates that most first world countries grow with. Now, in the past, when we were growing at 3%, 2%. There was a good year, we're growing at 4% as the economy. Now, it is going to decrease, not grow, decrease by 10%, meaning it's going to decrease by more than double what it's been growing with. That then means we have lost like 3-4 years of production as the country, if at this rate that everything is decreasing by. Now, when then we go to the interest rate as it stands now today, the interest rate today is at 7% because of what Gerrit said earlier on, because of the repo rate that dropped. So you will understand every time when the news break out they always focus on the repo rate dropping. They never focus on the interest rate, because the interest rate is as a result of the repo rate dropping. More than 99% of the time, which is 99.9999, the interest rate also drops at the same percentage that the repo rate drops. So remember the previous slide, the repo rate, which is the money, the interest that the South African Reserve Bank charges the banks, it was 3.75%. Now it is 3.5%. If you check on the slide, then next to that in brackets, in January, it was 6.5%. So the repo rate is almost halved, like literally almost halved. Again, that is part of the history of 47 years that has not happened. Now the interest rate is at 7%, the lowest, almost the same period of time that it has ever been. We will explain what this means later on. The lockdown, the traders opened after the lockdown, and we had said last week, what happens is people are now operating with knee-jerk response, meaning they got the results. I mean, they were locked down. Now they are told you can work, or in this instance, you can sell your properties to the sellers, and to the buyers, you can buy a property. And the estate agents were now released to work. And that created a serious, it is still increasing even today, activity in the market. That has not been seen to increase this fast in a very, very long time. And then the banks are now willing to negotiate up to 50% on bond registration fees as it is. They have even gone further. They broke another record this week with one of our clients. They had withdrawn the discount because of the client was going with another bank, and the client came back because all banks are now fighting over clients. And then we went back to the bank and we had said, no, listen, the client is coming back. If you're not reinstating the 50%, the client is going. And they reinstated it, the 50% discount on bond registration fees. Right now, for the first time in my livelihood, okay, I'm still checking how far back were the bank's reaction like this towards the clients. Normally the bank tells you what to do. They tell you and they don't negotiate. Right now, they're seriously negotiating. All right. And then the market is currently anybody's market, but the buyers again have just picked up an upper hand because they were starting to negotiate in the beginning of the week. You remember last week we had said the buyers are going back and forth with the sellers, and the agents were basically controlling whose market it is based on the transaction. Now the buyers have started to become an upper hand again, because now they can buy more, or rather they've got a bigger buying power, meaning they can buy more than they could a day or two ago. Now buyers need to be more educated now, which is why I'm sticking at this, you interpreting the market. Because what happens is currently consumers can Google anything, except even though it's there, they can read up, but it takes a lot of time to read up on what is a good time to buy a property, at what good rate, and all those things. So now you have to continuously be educated, and you just have to know more than what Google throws out. Because now the market is changing faster than Google can update their systems. All right, now as the first step as well, day one asset, you will hear this word up until you know, up until your system does this. A day one asset, it is a property that is making you profits from the first day. Remember, we had said that our definition at the beginning, a property is not automatically an asset. I know the accountants and lawyers are going to fight, and they fought, it's okay, but I'm talking in terms of building a portfolio and investing, the investor's mindset. A property only becomes an asset if it is making you money more than what you are spending on it. Then it becomes an asset. So though the activity is still that high and strong, I still urge you to try by all means to always buy a day one asset from the time, meaning the time you sign the documents to say I'm purchasing, even before you apply for a home loan, when you say I'm purchasing this property, it must already be projected that it's going to make money for you the first day that it is registered into your names or the entity you've chosen. Making profit, is it the right purchase? Is it the right location? Is it the right price? We've gone into detail for the sake of time. If you need to understand the details of this, please go to the previous webinars. I am also going to break it down as well in the future in shorter videos. Can we take the first round of Q&A, Siamo, so that we can now move on to what I'm recommending for the new changes that came in yesterday and going forward for a little bit while.
Awesome. All right, welcome once again to the people who joined us just as the presentation had already began. You are more than welcome today. Mr. Abella, we don't have any questions right now in the comment section. However, as we always do, we give a couple of seconds for you to raise your hand or to go to the comment section and put out your question right now. I'm also looking at our social media. I'm looking at our Instagram, and I am looking at our Facebook Live. So please send out your questions right now, and we will read them now and answer them as well. Thank you.
All right, let's do the seconds. If nobody, then I'm moving on for the sake of time. Going once.
Nothing yet.
Going twice, sold. All right, good. Let's go. Next question. Now, what does then this mean? What does this mean now for me? I'm sure every time, you've seen it every time the South African Reserve Bank announces a repo rate drop or changes there, all the news channels, they invite an economist to come and answer this question. Then what does this mean for an average person? What does this mean for everybody out there in the street? Now I'm going to put it in a way that you will understand and you will know what to do in relation to purchasing and selling property. All right, here goes. There's a couple of things I'm going to look at financial, and then I will not say the other slides that are coming. The first one is financial impact or translation. What does it translate to financially to me as the person who is building a property portfolio or planning to buy my first property, whether I'm going to stay in it or I'm going to sell it? It means lower monthly installments for the property purchases or any other credit agreement that you have. It also means if the installment is lower than you were paying previously, you will then have more cash in your hand because now you are paying less to the bank than you were paying previously. And then that then automatically means you've got breathing space, basically. You can now breathe a little bit. Maybe you are just left with, Now it has dropped. Now you have a little bit of more of a breathing space. You can buy that burger for lunch, you understand? And then it means then affordability becomes bigger. Meaning when you are checked or to be pre-qualified for a home loan or even for a car, that means then they will tell the amount that you could afford or they said you afford or qualify for previously will now be bigger than previous. Which of course, there on bigger affordability, it brings temptation to the consumer, which by the way was the intention of the intention of the Reserve Bank with the government to do that. Because what they want to do, they want to create a greater market activity. Now, also that needs to be understood a little bit, broken down a little bit. Market activity, when people are over indebted, they can't buy more. They can't consume more. In an example where a person, all their income is going to debts, that person cannot take new credit. That person cannot buy new clothes because they simply do not have money, because the money goes to pay, all of it goes to pay debts. Now, with the interest rate that has been dropping, that was the intention of the bank, Reserve Bank and the government from the beginning. So that drop the interest rate. When you drop the interest rate, people can afford more to buy because people only salaries were cut later on for a shorter period of time. But for those whose salary were not cut, for a guy, I mean, remember interest rate dropped from 9.5% to 7%, 9.75 to 7%. So if you were paying just before the lockdown, if you are paying 10,000 rand into your home loan, you are now paying just over 7,000 rand, 7,100. You have a whopping almost 3,000 rand extra. So the government created that so that you can be able to continue to do other things. Now, Some people, when we presented it, coincidentally, there was a big storm on Twitter, people saying it was a trap that the banks were creating. Don't buy, don't move. And then I said, yes, I agree for a consumer. If you're a person who's consuming, you are going to open an account so that you can buy more clothes. Don't do it. If you are going to go buy furniture on credit at a furniture shop, don't do it. It's a trap. But if it is an advantage for the people who are growing their wealth and they're growing their property portfolio, because that simply means that 3,000 Rand that you now have extra, you can purchase another property to increase your portfolio and increase income. You understand? Because that debate, which I'm going to touch now, the next slide as well, their debate was that later on, they are then going to increase, which is now with the possible future threats. The interest rates are going to increase. That's what people are saying. They're going to increase. But that is not for a person who's planning to grow. When you are a person that is an investor planning to grow, you look for a gap and for an opportunity, you move in, and then you secure yourself inside. So that then whatever happens, you have already done what you needed to do. And that window worked for you, all right? Now, there is still a possible just one more left repo rate cut. That is still possible. It might happen, it might not happen. Now, with the rates increasing again, which they're inevitably going to increase, now what then is my advice on that? They are not going to move from 7% back to 9.5 overnight. No. Just like they were dropping gradually, they are going to increase gradually as well. So when they start to increase, you'll have enough time to act on it. Now, I will then say my recommendations later on what to do from now up until that time to make sure that you remain in a safe and in a more advantageous position. Now, it means then the future possible threats, of course, there will be higher monthly repayments, so it will move now from 7,000, that 10,000 Rand home loan we're paying in January, to maybe again higher back to 7,500. And then there will be huge market downturn, rather, which is a recession. Yes, there were talks and debates. Yes, we are already in a recession, but there is a seriously bigger one that is coming and that is going to hit. This is the space that I really don't like. When I speak like that, I really feel uncomfortable because I feel like I'm a prophet of doom. That's why I don't like economists a lot. But nonetheless, it is the fact and it is the truth of what is going to happen. Now, this is the time then when you plan for the worst and you hope for the best. There will be job losses, serious job losses. We've already seen it happening. We've already seen Standard Bank close so many branches. We've already seen Edcon Group, which is Edgar's, shutting down and closing branches. We've already seen so many companies that are major that are closing and shutting down. Now, if the big ones that have got a big muscle are shutting down, how much more for the small businesses, which are the bigger ones in terms of carrying the everyday economical activity? Those companies are also shredding jobs. There will, of course, be less market activity because people will have less money to buy things. So that is why there were questions, even if you can check some, or you were watching the news yesterday, they were asking, how long can we sustain this? How long can these drops be sustained? Like I said, there's still possible one more drop that we can still sustain. But I am now moving you in the next slide, my recommendations, which is basically the last slide. I need to look at the time. I was told last time I must watch my time. So, because I get lost because I'm having so much fun. All right, now the recommendation is this. Do not fix your rate yet. Do not fix your interest rate yet. What does that mean? Previously, I had said to the people when I was addressing that issue, I had said that we would recommend people to fix their interest rates so that they can be able to not be affected when the rates go up again. If you have fixed it, they will go up, you will still pay the lower rate. So I am saying don't do the fixing yet. So what you do, you go to the bank. How do you fix the interest rate? You go to your bank that you have a credit agreement with or your home loan with or bond. Then you say to them, I would like to keep my rate fixed like this. Then you negotiate again, almost like when they were approving you, in terms of how long can they allow you specifically to fix the rate. Can they allow you for a year, 2 years, 3 years? Then they say, then you can fix your rate. Even when things change, they don't affect you. I am saying don't go to fix the rate yet with the banks. Secondly, buy now, but mostly and mainly financed deals, because you will then benefit in the low paying things, the low interest rates that are happening now. You will pay less, but have you noticed that with the interest rates dropping, the rentals did not drop? So the tenants are still paying the same amount. So if you buy bank finance property, that now you are going to pay 10,000 Rand, and now you are paying 7,000 Rand, that means then your expenses or your monthly expenses towards this property have dropped by 3,000, and therefore you've got a bigger gap. Now, what do you do with that bigger gap? You create a huge access bond. What is an access bond? We did a full webinar on it, so I'm just going to touch it now in 30 seconds. An access bond, it is almost like an overdraft or a credit card against your home loan, meaning whatever money you pay extra is also readily available for you to use for whatever needs you have, which also can be turned into you paying your home loan faster. And then for the cash buyers, I'm recommending to wait or customize your transaction. When I'm saying customize your transaction is depending on what transaction it is for you to buy. If it is a serious good deal, then buy. Because what's happening is now the market is active. It is still a buyer's market because there's still more sellers than buyers, but the gap was closed. You understand? Because of the current activity. Now that then simply means the statement that says cash is king, meaning when you've got cash, you've got room to negotiate the price for even lesser, is almost faded, because the seller knows that within a week or so, I will have another offer that is close to what I want. So I'm not going to rush for the sake of cash now. So I will rather wait. Thank you very much. So that's why I'm saying wait, unless it's a seriously good deal. And then the reason I'm saying wait, because the markets are going to take a dip, then get ready for the dip with your cash. Because when the markets take a turn, then there will be less people buying. When there are less people buying, the sellers become more frustrated or become more motivated to sell. Then when they're motivated to sell, you have got your cash, and then cash will really become king. And you will be able to get a very good deal that then you can decide on what to do later. Remember, you would have still gotten a cheaper that property for lesser than the real value of it, but the income will still be the high or the normal rental income that will be at the time. Or if you are moving in yourself, you will then would have gotten more money in your pocket, though it would not be in cash, but it will be in your worth or in value. That will have more money in your pocket. So that is why I'm currently recommending for cash buyers, wait to hold a bit back unless you get a very good deal, then you need to move very fast. But besides that, the people right now, even if you've got cash, if your credit record is good and the banks are willing to give you bank finance, then go buy with your bond. In the meantime, while you're holding on to your cash, cash flow is about to be seriously key in the next year or two. All right, and that is basically it. Thank you very much. I hope I did not take too long of the time. Back to you, Tsiamo, and let's entertain the questions if there are any questions. Thank you.
Awesome. The time is now 13:07. So well done, Mr. Tlali. I think that is your shortest presentation yet. All right, everyone. We promised you that we are going to keep this presentation shorter and shorter because we respect your data and we really respect your time. As much as we really appreciate you joining us every week, we also find ways to make these shorter, like I said, to save your data. All right, I've just put in this comment section right now here in Zoom that this is the time where you ask your question. You can either raise your hand or you can comment there by the comment section with regards to the presentation today. or you can ask any other question. Perhaps you saw something interesting. As I said at the beginning of the webinar, we are always looking for more interesting topics from you as the people who are joining us every week. We are always keen to learn more from you, to have discussions and so forth. Right now here on Zoom, we don't have a question as yet, but I believe that someone will put out a question shortly. In the meantime, we have a question from Facebook. It's coming from, I believe it's Noli. Okay, Noli is asking, what happens when the repo rate goes up 3 months later after taking a loan? That is Noli's question there on Facebook.
All right. Then if there are no questions, at least it gives me time to go deeper in it. Because thanks, Ndoni, for the question. I had already addressed it a little bit earlier on, but for the sake of time, I went over it. Now, like I said, I went deeper in the previous webinar, but I'm going to explain it now. Now, of course, the answer is you pay more. That's the basic answer. The point is not what will happen, is what do you do now when that happens. The rate, when the repo rate goes up, the interest rate goes up, your monthly payments go back up again. Now, the recommendations that I was making now are made in such a way that between now and that time, you are then able to create a safe space for you. So that when they do that, then you are safe and you are ready. By increasing your monthly bond payments, still pay more than the bank requires of you to pay. So that you create an access bond, you create a buffer. Should you not be able to keep up with the payments later on, that's one. Then you've got an extra money that is in your bond account that will then be turned into your monthly payments. Secondly, you then during this time, with the Reserve Bank and everybody excited, the rates are low, you then increase your income. So when you go spend money, or rather when you go access the credit, don't access it for consumption. In other words, for things that are not going to give you money back. You then go take that money and you use it for things that are going to give you more income. So that when it comes, you will then have more income coming through. Let me make it practical with that example I was making, to say you are paying a 10,000 rand per month for your bond, now you are paying 7,000 rand a month. You go buy a bachelor flat or any other property with the difference, which is 3,000 rands. Now with that, let's start it from the beginning so that you understand how this is basically part of compound interest that could work on your favor, sort of, during this time. All right, let me try to break it down in 1 minute. You go buy a property that you are going to pay the exact 3,000, the difference. Normally, a 3,000 per month home loan repayment would be for a property that is worth 300,000. This is on average now when the interest rate is about 10%. Then you pay 1% of your home loan equivalent amount. So for a 3,000 rand installment, that equals to, multiply by 100, a 300,000 rand property. Now, because the rate is low, for that 3,000, you will pay 3,000 for a 400,000 property. Now, if then you buy that property for 400,000 and you're getting a bargain, let's say the property is worth 500,000. All these examples I'm giving, it's things that we are doing for people right now. I'm not talking theory. You buy a 500,000 property for 400,000. That means you're already buying the property 100,000 below value, 20% below value. However, even further, you are paying 3,000, which means we are paying way less than you would normally pay for that property. A 500,000 property normally, if it is a good deal, it should be giving you at least 5,500 or 6,000 more per month. If it's below that, don't take it. So now, let's say you are getting the minimum amount, which is 3,000 rands a month. I mean, 5,000 rands a month worth of rentals. Now you've got your rentals. You are paying 3,000 rent. Let's say for argument's sake, you've got it's a flat in a complex. There's levies to pay and there's municipal rates to pay, and those amount to another 800 rand. So your expenses for that property are not only 3,000 that you are paying for the home loan, but also the 800. So you are paying 3,800. Now, what have you done? You have used the same amount you were paying per month previously to increase your income. Remember, you could afford the 10,000 property previously. Before the rates dropped, you could afford it. That's why you bought it. Now, the same 10,000 is paying for 2 properties. You only have to top it up with only 800 rand. Yet, you have increased your income with 5,000 rand. You understand, on the side. So when the rates go up both ways, you have created a safe place for yourself. Because even if it goes back to 10,000 this side is going to hit a roof. There's a roof that is going to hit. Let's say, for argument's sake, it hits 4,000 rands instead of 3,000 rand, meaning it increases by 30-something%. It's possible it just dropped by 30-something% now, so it gets to 4,000 rand per month. But your income is 4,800. I mean, your expenses are 4,800, meaning there's 800, but your income is 5,000, so you're still safe even then. So what you do now, that's what I'm trying to say when I say you set yourself up now so that when that time comes, you have an extra property, you have an extra income, and then you can be able to continue to move. And remember, after a year, that property's income is going to increase by 10% because you charge your rental you're charging your clients or your tenants increases by 10%. And if you had fixed your rates when it was growing up, at let's say from 3,000 euros now 3,500, you decide, okay, now it's going too fast. Let me fix my interest rate with the bank for 2 years. Now for 2 years, you've got a 2-year head start again for that income that is coming, that is giving you profit, to throw it into the bond, to have excess bond, so that when you go back to where everybody will be paying 2 years later, you would have extra income there in the property. I tried to make it as practical as I could. I hope it answers you, Madam Lynn.
All right, I'm looking at our Facebook Live right now. So Nolu, please tell us if that answered your question. She said that she was listening, so I'm just going to give her a couple of seconds to answer. In the meantime, let's go to the next question, which is on Facebook Live as well. So thank you everyone that is watching right now on Facebook Live for joining us today, and thank you for your questions. Please do keep them coming. The time is now 13:16. Please remember that we have the session until 13:30. Yeah. The next question is coming now from Mahlatsi. Mahlatsi is asking, what's the difference between excess bond and a further bond?
Okay. An excess bond, it is the money that is extra, that is in your bond account. They normally open 2 accounts. The bond account is what you pay into, and then they open an overflowing account so that it can easily be separated, so that you can easily access it whenever you need the money from your access bond. So the access bond is what you have paid extra. You understand what I'm saying? Now, a further bond, it is when you go to the bank and say, I need more, borrow me more. Instead of the 1 million that I had, I need more. I need another 200. So borrow me 200 more. That's a further bond. You are taking a bond, taking your home loan account further. You are making it more. Access bond, you created, further bond you are given by the bank. I hope that answers the question. Please confirm if she was answered.
All right, that is fine. I'm just looking right now at the video. Mahlatsi, please let us know if your question is answered there on the live comment section as well. All right, let us see.
If I can chip in, there was
she has not.
There was a comment on Instagram that I wanted to just make a comment on that comment.
Okay, thank you.
Someone is saying on Instagram, so the Reserve Bank prints money and then borrows it out to the banks to make money. Yes, that's the long and the short. Yes.
Yeah.
Though they have limited amount of money that they can print. That is why you printing money for yourself is illegal. It is not only legal that you'll be getting money that is but you will be disrupting the circulation of money. If you check into your notes, they've got numbers. The notes are numbered, and those numbers legitimizes them, including those menu marks that are in the note and all those things. Even the Reserve Bank, though they print money, they can't just print, understand, inevitably up until the end. It then changes things. Zimbabwe tried to do that a little bit because now they were not complying with international monetary laws. They were just making their own. That is why one of the indicators of your bad or dropping economy is when you print bigger notes. Meaning when you print a 500 Rand note instead of more than the 200. So you've got 200 Rand and less notes. That means then you've been able to keep things stable and control your printing properly and circulation of notes well. When you have the need to print a bigger note, that means the value of the previous note has really dropped so bad that the new note has to be introduced. As you would know, in our neighbor Zim, the note had to be increased so much into millions and millions in terms of just a couple of notes, and you had that money. Now, that's basically what the Reserve Bank does. Of course, there is money that the country borrows from the World Bank, from the International Monetary Fund, from this, everywhere where they borrow as well. And that is where then it is discussed in the budget speech, the fiscus, the ratio of our credit, the loan interest that the country we borrow from outside versus what we are making and growing as, or rather with as a country. And that's what basically mostly affects the economy. Because what happens is we are going, the economy is should I say, expected to shrink or decrease by 10%, but the country has got loans to pay. So just like you and me, if you've got a loan to pay, your income drops by 10%, but your loan provider does not give you the breather, then that means there's trouble, because then you are decreasing more than you are growing. Soon enough, you will, if not something is not done properly, you'll end up being insolvent or bankrupt, where you will reach, the expenses will now exceed your assets, or your liabilities will exceed your assets. All right, I am done unless there's one or two more questions. If not,
there actually is one or two more questions, Mr. Dlani.
Right.
The time still allows. We have 9 minutes before we officially have to close this
session. All right.
Okay, we have a question from Bogang. Bogang is saying that my wife wants to buy property with her dad. Her dad is from Lesotho. What would the bank require for him as a Lesotho citizen? This is a question here in our comment section here on Zoom. Thank you, Bogang, for that question.
All right, that is a question that that many people don't know how to address or deal with the banks. I remember we even did it the other day when we were doing the bonds. I think I remember. What happens is, when the bank gives you money, that's why they want a credit record. They assess your risk. How risky are you as the borrower to me as the lender? Are you carrying a lot of risk? And there are many ways or things that the banks do. It's actually a long list that the banks go through to assess your risk. Do you have a bad credit record? I mean, we know your track record speaks volumes. Chances are it's what you're going to do in the future, unless there's drastic changes that are done or you have a serious Jesus encounter. Now, that's one. I can mention, and there's many others. The type of industry you are in. How stable is it? Are you permanently employed or not permanently employed? Do you get your salary on weekly basis or on monthly basis? What is your age? How much time do you still have that you can work and you can be able to pay this home loan? There are so many things that they look into, including your citizenship. Are you a South African citizen or not? Now, the bank's biggest fear is you not being able to pay them back their money. That is the basis of all this risk analysis. You not being able to pay them back their money. Because what happens is when you don't pay them back their money, they then have to repossess your property because it remains yours up until sold on auction, unlike a car where they just come and take theirs if you don't pay it. So now they then have to repossess the property, though you are still staying in it. They repossess the documents, they've attached the property, the home loan against the property, they have kept the title deed. Now they are just enforcing those measures that they took ahead. Now what then happens is either sometimes people leave or people just stop paying, but the bank runs a risk of that property being sold for less than you owe them at an auction. So what then they do, in that, just using that example, for international citizens, they then check what are the risks of this person abandoning the property and skipping the country. Now, when then you do not have citizenship, then they say, oops, the risk is very high. Then, all right, let's try and minimize the risk. Does this person have a work permit in South Africa? All right, yes, but how long is it? 5 years, 10 years? So that we know our risk? Or this person is here on just stamping at the border, coming in and out? Or is this person doing business and visit frequently? So they look into that, but then they come to the conclusion. Most banks want 50% deposit to be paid by non-South African citizens against a home loan. Now the dynamics change when then they buy together with a South African. Then because their risk has dropped, they also drop the deposit that they require. It moves, it depends from bank to bank, how much deposit or how much risk they are willing to take in terms of dropping the deposit. Therefore, in such instances, there's a couple of ways in which you can do it. We can advise further a customer advice, because I don't think, even though I will answer to say they might want 50%, they might, and it's understandable where it's coming from, but there might be one or two things that are different with your scenario. So I would encourage you, please do contact us or put your send your contact details to Tiamo right now privately, so that we can contact you and be able to assist you in implementing it properly and well. Because there are many ways that we can do it to minimize that risk or to increase the percentage that the bank is going to give and minimize the deposit that might be required. Thank you.
All right, thank you. Thank you so much, Mr. Tlali. Bokang, can you please switch on your mic or switch on your video, just indicate if you are satisfied with that answer, or do you have a follow-up question, please?
No, I'm sorted. Thank you. I just wanted to hear on the issue of deposit. That was the major thing.
Awesome.
Deposit,
Thank you.
yeah.
Thank you so much, Bokang.
Thank you.
All right, now we move on to our social media. Mr. Yapela, that is all the questions for now on our social media. However, we do have 4 minutes left. I just wanted to ask on another question that I saw on Twitter, which asked, so basically the person was asking about the trillions that is apparently being owed by the rest of the world. And the person wanted to know, who does these countries owe?
Okay, no, that's going to take us really deeper. I'm trying to think, because sometimes some of those questions, you can't freely answer them without going political.
I understand.
Because some of the world's richest people do borrow money and finance these financing institutions. So that
you can send an e-wallet to the country.
You understand now? You understand now?
How levels.
So that is why there are the theories and the talks and many things that there are so many families that control the whole world, that own the world and all those things. So it goes seriously deeper. It is like, yes, it is serious levels that go with it, who do they owe, and it's those endless questions that can keep going and going and going and going. But those things are never really discussed seriously open, even by the people who are running those institutions, because then it will expose them that they are already compromised. because then they owe Yabela now. You see, now Yabela must now go and repossess the you understand? The Parliament building in Cape Town because South Africa owes Yabela. Eh? Those days are coming.
Well.
I'm speaking them to life. Yes. All right.
Awesome. All right. Thank you. Thank you, Mr. Tali. I'll now give you a chance just to wrap up for us quickly for today. There aren't any questions coming. However, I do want to thank everyone who joined us, everyone who was also joining live on our Facebook and our Instagram. Thank you so much for joining us today.
All right. Thank you. I'm going to close with these words. And I've been saying this, and I'm now almost at the stage of begging people for their own sakes, is that please don't do things by yourself that need professionals. Mostly in a time where there's serious activity. You stand a chance of losing more than of getting. Google is not enough. Google just gives guidelines. It gives a picture so that you can start to ask questions towards that specific direction. Google, get more info, please. You need to get info. You need to get educated. Over and above that, you need to come close and approach professionals that can be able to help you, work with you, walk the journey with you to a place where you can also have confidence to can know certain things and be able to do them. Now the market is extremely active. If you are a seller, take it out, put it on the market now, and be ready to negotiate just a little bit. You would rather have it gone now if it's a burden to you than when there's few people selling later on, and if you want to sell. If you're a buyer, you are buying through the bank, you are the good, best buyer right now. Buy. Look for the best price. If you are a buyer using cash, try to avoid using it now unless the deal is it's a deal that you cannot refuse. It is incredibly good. And save your money for later, because later money will matter a lot. And thank you for watching the webinars. Learn more and be in touch with us so that we can be able to assist you going forward. Thank you very much. Or before I forget, I wanted to make an announcement. I got a call from 2-3 clients. We are, what do you call this? Migrating or moving our server from a certain server that was limiting our operations as the business. And the business is now growing. So therefore we have to migrate to a different server. So for 2 to 3 days, we are out of communication via emails or via anything. You can just call us. You can send the email. We will then attend to it at a later stage, which is early next week. And then we'll be able to assist you. But besides that, thank you very much. God bless you.
Thank you. Thank you so much, Mr. Tlali, for these sessions. And thank you, everyone, for joining us week in and week out. Remember to follow us on Instagram at YDT Group SA. We are on Twitter, YDT Group Online, and here on Zoom every week as we put up the link. And on Facebook, our Facebook page is just simply YDT Group. Thank you. Thank you so much, everyone. God bless you.